Hey, good morning once again, options traders. Well, I received an email from one of our traders asking a specific question and saying, can you find an options fair value, or how do you find it? And it really became a little bit more of a philosophical discussion of saying that yes, we can come up with a number that we might call the fair value, but it's not necessarily the options fair value because it's really subjective. Now, I talked about this in an indirect way recently in a video called Does Implied Volatility Give You an Edge? So this is a related video, but just a little more directly addressing this question. So let's take a look. Can you find an options fair value? So to start off, we're going to first look at a futures contract to show you how in one case it can be very easy to figure out fair value. So the fair value, remember, is the price at which the buyer and seller are expected to break even over the long run. So if we have this number that we call a fair value, and you were to buy it or sell it hundreds and hundreds of times, not counting commissions, you would just break even. It's a price that doesn't favor the buyer or the seller. It's fair. And it's always this mathematical concept whenever we talk about a fair value. So for a futures contract, let's look at the SPX, the S&P 500, trading for about 44.30 right now. This is what we would call the cash price or the spot price, the price where you can buy it on the spot, so to speak. And let's say that there are 90 days to expiration for this contract. And just to make the math easy, I'm going to say that interest rates are 4%. So remember that interest rates are always assumed to be over the course of a year. So because this is 90 days or a quarter of a year, we have to scale this. So we take 4% times 90 over 360 or times a quarter, and we get 1%. So next I'm going to take the cash price, 44.30, times 1 plus the effective interest rate, or what we would call the periodic interest rate, 1.01, and we get 44.7430. But now we have to subtract out dividends, because if we own the S&P 500, we're going to collect dividends, and that's a cash inflow or a benefit for us. So we have to subtract out dividends, and right now the dividend yield is about 1.3%. So we take 44.30, that's the spot price, times the dividend yield, 0.013, again times 90 over 360 equals about 14.40. So the futures contract would trade for 44.7430 minus this dividend amount, 14.40, and that gives us 44.59.90. So this would be the price we would actually see in the market, 44.59. Now the reason we can say that definitively is that if it's trading above or below this, there's what's called an arbitrage opportunity that is going to force it back up here. So without going into the details, if the futures price were above this, let's say at 44.60 or higher, what's going to happen is that traders called arbitrageurs would borrow money. They would buy all of the shares in the S&P in their exact proportions, and then they would sell the futures contract, which remember is overpriced. And so that gives them a guaranteed sale. When you sell a futures contract, it is a guaranteed sale. So their actions are going to put buying pressure on the spot price and simultaneously put selling pressure on the futures price, and that's going to bring this fair value right back into line. On the flip side, if it were trading below, let's say it's trading for 44.55, then the futures are too cheap relative to the S&P 500. So in this case, they will short the S&P 500, receive cash, and then they have a short position to cover in the future. What they will do is to take that cash and to buy the futures contract, which is too cheap, and they will have some extra cash sitting into the money market that earns interest. So when they get to expiration, they will have more cash than is necessary to buy this futures contract. And when they do that, it closes this out, and they've been left with the free money. So in this case, they would put buying pressure on the futures contract, push its price back up to 44.59, and they would put selling pressure on the actual index. But the point is that we can definitely say this is the price where we will see that futures contract trading in the open market. However, when we get to an option that is no longer true. And that is because the fair value of an option depends on volatility. But it's not just any volatility. We need to know the volatility that will occur over the option's life. Well, that hasn't happened yet. If we have a 90-day option, it's not at expiration yet. So what's the volatility that will occur over the option's life? We don't know. Now, sure, we can guess, we can come up with really good guesses, but it's not the same as it is with other financial assets, such as futures contracts. So when we talk about an option's fair value, it's only as good as your guess. So once again, can we come up with a number, or another trader says, well, I calculated the option's fair value and it's this. You always have to take that with a degree of skepticism because it's always based on that person's assessment of volatility. So to see a little more detailed example, let's go over to the E-Trade platform. So now we're into the E-Trade platform. I've got S&P 500 right here. And if you click on this link that says quote, and down below, you'll see a chart of the S&P. And if we raise this up a bit, we get two graphs. And the blue is the actual, or what we would call the historic volatility for the S&P 500. And the orange line is the implied volatility of the options, basically the at-the-money options. So you can see that the index is trading with a volatility of about 11.9, almost 12, but the implied volatility is about 15.6. So that might not sound like a big difference, but percentage-wise, it's a pretty good jump. So if we say, okay, right now, based on the historic volatility, that the options are fairly expensive. But watch how easy it is to change that. I could say, well, I think that the future volatility is going to be 20%, like it was back into here. Now this option looks cheap because it's priced below. It's priced at 15.6%. On the flip side, I could say, well, I think the future volatility is going to be down here at about 10%, like it was over here, and now the option looks expensive, and therefore I should lean toward selling it. So see, I can pick any number that I want. Now, of course, in the real world, we're going to try to find out where we are relatively speaking to the highs and lows. And this is where we can use things like vol cones. So those will be things we might talk about in the future. But the main thing that I want you to understand now is just when you hear a trader talk about an option's fair value, it's very subjective. It's only as good as the volatility input that you give the pricing model. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.